Right now, you can move up to $390,000 into super in a single go using the bring forward rule. From the 1st of July 2026, that is the new maximum, and a lot of Australians are already making plans around it. But here is what most videos on this topic leave out. Putting that much into super could actually cost you up to $44,000 a year in age pension. That is not a typo. The very rule designed to help you grow your retirement savings can quietly shrink your retirement income if you use it without checking one number first. I've been in this position myself, sitting on a lump sum, thinking that moving it all into super was the smart move, and nearly missing the pension impact entirely. Not because the rule is bad, because nobody ran the full calculation. The trade-off between tax savings inside super and lost pension benefits is worth at least $44,000 a year for a couple, and almost every video on the bring forward rule skips over it completely. So today, that is what we are going to fix. I'm going to show you exactly why this trap exists, how to calculate your personal break-even point before you make any contribution decision, and the scenarios where using the bring forward rule is a clear win, versus the ones where it quietly costs you more than it saves. If you are between 55 and 65, have a decent super balance, and have cash sitting outside of super right now, this is the video you need to watch before you do anything else. Hit subscribe so you do not miss what is coming up, because the number that matters most is not $390,000. It is the one we are about to calculate together. Let's start with what the bring forward rule actually is, because the name sounds more complicated than it needs to be. Normally, you can contribute up to $130,000 per year in after-tax money to your super from the 1st of July 2026. That is the new non-concessional cap. But the bring forward rule lets you pull 2 or 3 years of that cap into a single year, which means instead of $130,000 this year, and $130,000 next year, and $130,000 the year after, you can contribute $390,000 in one go. The government lets you borrow from future years in the financial year just ending, 2025-26. That cap was $120,000 per year, so the 3-year bring forward maximum was $360,000. From the 1st of July 2026, it rises to $130,000 per year, making the maximum $390,000, a $30,000 increase. But access to the full 3-year amount depends on your total super balance, what the ATO calls your TSB, at the 30th of June in the year before you contribute. If your TSB at the 30th of June 2026 is below $1.84 million, you can access the full $390,000 bring forward from next financial year. If your balance is between $1.84 million and $1.97 million, you only get 2 years worth $260,000, not $390,000. And if you are between $1.97 million and $2.1 million, you are limited to a single year's cap, which is $130,000. Above $2.1 million, you cannot make any after-tax contributions at all. I used to think that every dollar inside super was a dollar better off. It took looking closely at a real scenario to realize that logic can go backwards when the age pension is involved. Here is why. Super counts as an assessable asset under the age pension assets test once you have reached preservation age. So when you move money from outside super into super, you are not hiding it from Centrelink. You are just shifting it from one place to another. The total assessable pool stays the same, or can even go up if you are bringing in investment returns that were previously outside the system. Now think about what happens when a home-owning couple has combined assessable assets of around $900,000. They are inside the age pension assets test taper zone. Services Australia currently applies a taper of $3 per fortnight for every $1,000 of assessable assets above the lower threshold for a homeowning couple, which sits at $1,500. That works out to $78 per year in reduced pension for every $1,000 over the threshold. If that couple uses the bring forward rule to move $150,000 from outside super into super, maybe from cash savings or the sale of an investment property, their total assessable assets climb from $900,000 to $1,050,000. Under the assets test, that pushes them past the upper threshold of $1,019,500 for a homeowning couple. At that point, the age pension goes to zero. They could lose somewhere around $9,000 per year in pension entitlement, simply by making a contribution that looked like a smart tax move on paper. This is not about avoiding tax. It is about not letting a well-intentioned strategy cost you a benefit you have earned through a lifetime of work. The rule itself is not the trap. The trap is making the decision without checking where you sit on the assets test, and without calculating whether the tax benefit inside super outweighs the pension you give up. So the question is not whether to use the bring forward rule. It is whether using it and how much of it to use improves your total retirement income once you count both the tax saving and the pension impact. That calculation is different for every person, and that is exactly what we are going to work through next. The reason this catch trips people up is that they are making the decision with one number in their head, the tax saving inside super, and ignoring the other number, which is what they stand to lose in age pension. So let me walk you through a simple 3-step framework to figure out which way the calculation runs for your situation. Step 1 is to map your total assessable assets. That means everything you own outside your family home, your super balance, your bank savings, term deposits, shares, investment properties, and any other financial assets. Add them all up. This is the number that Services Australia uses to assess whether you qualify for the age pension, and if so, how much. Step 2 is to estimate your current age pension entitlement using that total. You do not need a financial advisor to get a rough answer here. You just need to know the assets test thresholds and run the taper rate. For a homeowning couple, the lower threshold is currently $451,500. For every $1,000 of assets you hold above that lower threshold, your pension reduces by $3 per fortnight. The maximum couple rate is around $44,000 per year. Your pension drops to zero when your assets reach the upper threshold of $1,019,500. Write down what you currently get, or would get, if you retired today. Step 3 is to compare two scenarios side by side. Scenario A, do not use the bring forward rule. Keep the money outside super. Work out your pension entitlement. Add the investment return you are getting on those outside assets after tax. That is your total income picture for Scenario A. Scenario B, use the bring forward rule. Move the money into super. Recalculate your assessable assets, and then rerun the pension test. Then add the super earnings, taxed at 15%. That is your Scenario B income picture. The one with the higher total income wins. Now let me make this concrete. I remember one client, a retired teacher, a woman in her early 60s, who had $50,000 in a term deposit, earning around 4%. That was $2,000 a year in interest, taxed at her marginal rate. She came to me wanting to put it into super to get the better tax treatment. When I ran the pension numbers, it turned out that moving the $50,000 into super would push her assessable assets above a threshold, and she would lose roughly $2,000 a year in pension. The extra super earnings at 6% on $50,000 would be $3,000, but after 15% super tax, that is $2,550, and she would lose the $2,000 in pension. Net gain, around $550 a year. It was marginal. But once I explained the trade-off, she decided to keep the cash where it was and hold on to the pension certainty instead. That is the kind of calculation most people are not running. They see the tax-saving headline and move. What they miss is the pension subtraction. Now take a different example. A couple I will call Bob and Sue. Both are 63, own their home, and have combined super of $700,000, $350,000 each. They also have $200,000 in outside savings. Total assessable assets, $900,000. Under the current taper, that works out to about $448,500 above the lower threshold. At $3 per fortnight per $1,000, their age pension is reduced by around $1,345 per fortnight from the maximum. The maximum for a couple is about $1,692 per fortnight. So they currently receive about $347 per fortnight, roughly $9,000 per year. Now, if Bob and Sue use the bring forward rule to move $150,000 of that $200,000 into super, their total assessable assets climb to $1,050,000. That is above the upper threshold for a homeowning couple at $1,019,500. Their pension drops to zero. They lose $9,000 per year. Is the tax benefit worth it? The $150,000 inside super earning 6% generates $9,000 a year before tax, or $7,650 after the 15% tax rate. Compare that to $150,000 outside super earning 5%, taxed at a marginal rate of, say, 20%. That is $7,500 after tax. The super earnings come out slightly ahead, but only by $150 a year, and they lose $9,000 in pension. The maximum age pension for a couple is $44,000 per year, tax-free. If boosting your super costs you any portion of that, you need to be very certain the extra super earnings make up for it. In this case, they do not. The break-even balance is the exact point where any additional contribution stops helping you and starts costing you. Finding that number is the most important calculation you can do before signing any contribution form. But what if you are already well above the pension thresholds and the question is purely about tax efficiency? That is a different story entirely, and it is where the bring forward rule genuinely becomes the smart move. Let's look at that next. Let me show you two scenarios that sit at opposite ends of this decision, because the bring forward rule is not universally good or universally bad. It depends entirely on where you sit relative to the pension assets test. Scenario 1. Mary is 64, single, owns her home, and has a super balance of $1.8 million. She also has $200,000 sitting in a managed fund outside super. Total assessable asset, $2 million. For a single homeowner, the age pension upper threshold is significantly lower than that. So Mary is already well above the limit and receives zero pension. That will not change if she moves more money into super. For Mary, the question is purely about tax. That $200,000 outside super is generating investment returns that get taxed at her marginal rate. Let's say it earns 5% per year, that is $10,000 in earnings. And at a marginal rate of 34.5%, including Medicare, she pays $3,450 in tax, net return, $6,550. If that same $200,000 were inside super earning 6%, she would get $12,000 taxed at 15%. Netting $10,200. That is a $3,650 difference per year in her favor. And once she turns 60 and starts drawing from super in retirement phase, investment earnings inside are taxed at zero. The advantage grows significantly over time. For Mary, using the bring forward rule is a clear decision. The pension is not in play. The tax saving is real. move the money. Scenario 2 is more common and more dangerous if you go in without the numbers. This is a couple, let's call them David and Carol, both 65, own their home, combined super of $700,000 and $300,000 outside in term deposits and shares. Total assessable assets, $1 million. Under the assets test taper for a homeowning couple, they sit inside the taper zone. They are currently receiving a partial age pension of roughly $5,000 per year. They want to use the bring forward rule to move $150,000 from outside super into super, mainly because they heard the tax rate inside is better. That part is true. But here is what happens to the pension. After moving $150,000, their total assessable assets become $1.15 million. That is above the upper threshold of $1,019,500 for a homeowning couple. Their partial pension goes to zero. They lose $5,000 per year. The $150,000 inside super earns 6%, producing $9,000 before the 15% tax, or $7,650 after. The same $150,000 outside was earning around 5% on term deposits, taxed at a lower marginal rate given their reduced income in retirement. The net outside return was roughly $6,000 after tax. So super earns them about $1,650 more per year. But they have given up $5,000 per year in pension to get it. They are $3,350 worse off each year. That is not a minor rounding error. Over 10 years, that is $33,500 in net loss. Before counting the value of having the age pension as stable, guaranteed income that is not subject to investment volatility. Services Australia's assets test taper is $3 per fortnight for every $1,000 of assets above the lower threshold. That works out to $78 per year per $1,000. For a couple, moving $50,000 in outside assets into super can cost $3,900 per year in pension if it pushes you past the upper threshold. That is money that does not appear on any contribution form. The verdict for David and Carol: do not use the bring forward rule at current balances unless they find a way to bring their total assessable assets back below the upper threshold through other means, like spending on the home, medical costs, or other non-assessable items. Now, at this point, some of you might be thinking, what about the risk of the government changing super rules again? Because that fear is real, and it is causing a lot of people to hold back entirely. Let's talk about that. There is one more barrier that keeps people from making any decision at all, and I want to address it directly. A lot of Australians in their 50s and 60s are nervous about putting more money into super because they do not fully trust that the rules will stay the same. And honestly, that is not an irrational feeling. In recent years, there has been talk of Division 26, the proposed additional tax on super balances above $3 million, and various proposals around taxing unrealized gains. You have watched the contribution caps change over time. You have seen the goalposts shift. Feeling hesitant is completely understandable. I used to believe that every dollar should go into super because the tax treatment was permanent and reliable. I was wrong about permanent policy changes. That is something I had to acknowledge, and it changed how I think about contribution decisions. But here is the thing. The fear of future policy changes can cause just as much damage as making the wrong contribution decision. When that fear leads to paralysis, leaving large sums in a bank account or managed fund at a higher tax rate, because you are waiting to see what happens, you are paying a real ongoing cost right now in exchange for protection against a risk that may or may not materialize. Instead of thinking of super as a locked box you cannot escape, try thinking of it as a tool you control within a set of rules. You decide how much to put in. You decide what to invest in. You decide when to start drawing it down once you are eligible. The bring forward rule gives you optionality. It does not require you to contribute the full $390,000. You can contribute whatever amount makes the numbers work for your situation. $50,000, $100,000, $200,000, and stop there. The practical step I would suggest before committing to any amount: write down the maximum you are genuinely comfortable locking away in super for the next 5 or more years, not what the cap allows, what you feel settled about. For most people, that number is somewhere between half and 2/3 of their available surplus cash. Start with that number, not with the maximum, because a contribution you feel confident about and can leave alone is worth more over time than a maximum contribution that you second guess every time there is a budget announcement. Let me give you a practical sequence to follow. Not a financial plan, a checklist to help you understand your own position before you speak to anyone, or before you make any contribution decision. Step 1. Confirm your total super balance at the 30th of June 2026. You need this number because it determines which version of the bring forward rule you can access from the 1st of July 2026. Check it directly on your Superfunds online portal or through the ATO's MyGov portal. The thresholds from the 1st of July 2026 are below $1.84 million, means you can access the full 3-year bring forward of $390,000. Between $1.84 million and $1.97 million gives you 2 years, $260,000. Between $1.97 million and $2.1 million limits you to 1 year, $130,000. Above $2.1 million, and you are not eligible for any after-tax contributions at all. Step 2. Calculate your current age pension position. Use the Services Australia Assets Test. For a homeowning couple, the lower threshold is $451,500 and the upper threshold is $1,019,500. For a single homeowner, those thresholds are different and lower. If your total assessable assets sit between those two numbers, you are in the taper zone and you are receiving a partial pension. Any contribution that pushes you past the upper threshold eliminates that pension entirely. Step 3. Identify your liquidity buffer before you commit to any amount. Keep at least 6 to 12 months of living expenses outside super, plus an emergency reserve of around $20,000 to $30,000 that you can access without going into super. Super is not a transaction account. Once the money is in, you cannot take it out until you meet a condition of release. Step 4. Run the comparison. How much extra would you earn inside super after the 15% tax rate compared to what you are earning outside? Subtract any pension you would lose as a result of the contribution. If the number is positive, it is worth considering. If it is negative or near zero, the case is weak. Step 5. Think about timing. Because the caps increased on the 1st of July 2026, if you want access to the new $390,000 maximum, you need to wait until after the 30th of June to trigger the bring forward, and your TSB at that date needs to be below $1.84 million. But if your balance is close to a threshold, it may be worth checking your position sooner rather than later, so you are not caught out by investment growth pushing you into a lower category. Now, here is something separate but urgent. If you have unused concessional contribution cap amounts from the 2020-21 financial year, those expire on the 30th of June 2026. Carry forward concessional caps only stay available for 5 years. If you have an unused cap from 2020, 21 and your total super balance is below $500,000, you can still claim a personal deductible contribution before the end of this financial year. If your unused amount is $15,000, contributing that before June 30th and claiming it as a tax deduction could reduce your taxable income by $15,000, saving you up to $7,000 in tax depending on your marginal rate. That window closes in days. It is worth checking now separately from any bring forward decision. If you want to stay across this kind of update, when caps change, when thresholds shift, when the carry forward window is about to close, that is exactly why subscribing to the channel matters. Every week I go through the things that actually affect Australians in their 50s and 60s, without the jargon and without the sales pitch. Let's bring this together. The Bring Forward rule is a genuinely useful tool. From the 1st of July 2026, it lets eligible Australians contribute up to $390,000 in after-tax money into supers in a single year. That is a meaningful amount, and the tax benefits inside super are real. But today you have learned 4 things most videos skip. First, the caps have just changed. $120,000 per year becomes $130,000, and the 3-year maximum moves from $360,000 to $390,000. Second, the hidden pension trap. Boosting your super can cost you up to $44,000 per year in age pension if you do not run the assets test first. Third, the 3-step framework. Map your assessable assets. Check your pension position. Compare both scenarios side by side before you commit. And fourth, a simple action plan. Know your TSB. Protect your liquidity buffer. And check whether your carry forward concessional cap from 2020-21 is about to expire. I do not know the details of your financial situation. Every number in this video is a guide, not personal advice. But if you take one thing away, let it be this. Never move more into super than you understand the full impact of. Test the numbers first, then make the decision. If this was useful to you, subscribe to the channel. I put out a new video every week covering the retirement system that affects Australians in their 50s and 60s. The real numbers, the real trade-offs, without the noise. See you in the next one.